and welcome to the latest episode, actually the finest episode in this series of Behind the Charts. I'm Dave Keller, the Chief Market Strategist here at StockCharts.com. We've thought a great way to finish off this set of interviews for our second season of Behind the Charts was with Larry McMillian. Larry wrote a book called Options as a Strategic Investment that was one of the first books on options that I read, and hundreds of thousands of others in the market can describe themselves the same way. He literally wrote the book on options because Larry was involved in the early 1970s, right as the listed options market was created, as it was evolving from an over-the-counter market to a listed options market. So much of the things we take for granted in terms of analyzing options, pricing options, strategies using options, people like Larry really created that. They really designed it over time. Larry's an educator, an analyst, a money manager. We talk about all of his lessons learned over many decades analyzing equity derivatives. Ladies and gentlemen, here's Larry McMillian. All right, so we're sitting down today with Larry McMillian. Larry, it's awesome to sit down with you. I've followed you and your work, and as you probably could guess, because I would say most people probably describe themselves this way, one of your books on options was the first book I read to learn about equity derivatives. So it's fantastic to sit down with you today.
Oh, glad to be here. Yeah, a lot of people have read that book, especially during COVID.
That's what I was going to say. When we have time to sit down and sit at home and learn about the options market, it's the Options as a Strategic Investment. It was very, very well done, and you've had a number of successful editions on that. But let's get started at the beginning. Larry, tell us, where are you from originally?
I'm originally from South Bend, Indiana, and went to Purdue and then University of Colorado for grad school.
Very good. I did not know you were a fellow Midwesterner, actually. I think of you as a New Jersey guy, but that's very interesting.
You don't hear those flat A's?
Oh, I love it. And then where was your introduction to the financial markets? Was it early on? Was it when you got to college? How did you kind of get started?
Sort of interesting. So when I was going to grad school, the Denver Broncos had a package at the beginning of the season. You could buy up to 4 tickets for each of 4 games. So I'm standing in this line. I always said literally it was a mile high and a mile long because Denver's a mile high city, and it was huge. So I ducked in this bookstore and grabbed this book. It had some cheesy title like, How to Make a Million or something, but it was actually a book about convertible bond arbitrage, and it was very, very respected. I think the author's name was Schulman. Anyway, so that was my first introduction to derivatives, but I understood it pretty well, traded it, just as a little bit when I was, still in grad school there, and then when I got to I took a job at Bell Labs. That's how I got to New Jersey. And so when I was doing that, then options started trading, and my broker called me up and said, "Hey, you better take a look at this. It looks pretty interesting." And so it just clicked with me. I mean, everything about it just clicked. So there weren't too many books at the time.
Right.
I did read one about ratio spreads. It was the only one that was not just about buying options and buying call options, because there were no puts then.
Right.
And so a little bit illustrative or what have you, but I started trading my own account, writing my own. The Black-Scholes model had just come out, so I had access to some pretty powerful computers at Bell Labs. So I was writing my own modeling stuff and started a newsletter. Ivan Boesky was one of my early subscribers. It was way back, 1975 or so.
Wow.
And then my broker was at Thompson McKinnon. He called me one day and said, "Hey, there's an opening in the retail department. Would you be interested?" So I went there, and that worked out pretty well. And I was writing a newsletter for them, just describing strategies. And the New York Institute of Finance went to the president of the CBOE at the time, was Jim Dolan, and said, "Hey, we're looking for a book on option strategy." And he said, "Well, there's this guy, I've been reading his stuff over at Thompson McKinnon. Maybe you should call him." And so it just, they asked for an outline. I submitted this huge outline, and wrote the book, and they published it. And right at the end of '79 was the first edition.
Wow. So it's fascinating. So many, and myself and others have come into equity derivatives or learned about them down the road. You were there really as things were just getting started. What can you tell us as you've seen the options market grow and evolve over time? What were those early days like? I mean, relative to what we're seeing today?
Well, there was a lot of free money laying around, in terms of options could be bought on expiration day for less than parity, and you sell the stock and exercise the call, and make free money. I don't know why the market makers let that happen, but it did happen. And then options were extremely expensive, and this was 73. The bull market was still kind of going on. It rolled over into a bear market, and the options got even more expensive. But I mean, that's the two things that I remember the most. So there's a lot of things showing up in terms of the Black-Scholes model as being overpriced. I don't think any of us really fully understood implied volatility and all volatility back then like we do now. But it was certainly some very interesting times, and option sellers really did have the upper hand originally. They don't anymore, I don't think, but they did at the time.
Right. And then, so tell me this: when were you introduced particularly to technical analysis? How did that fit into your toolkit?
Yeah, so that came back before I was when I when I was trading convertible bonds. It was actually, I had opened an account when I was in the Army prior to going back to the University of Colorado, and I was in Washington, D.C., and I had inherited a little money from my father. So went into a brokerage office there, and they, I was wearing my, private's uniform or whatever. I was working at the Pentagon, and they just assigned me to, the newest broker in there. But he and I had a very long relationship, and he got me into technical analysis pretty early on. So I was probably 72, maybe. No, 70, in 1970, something like that.
Right.
So, and to me, again, it, just struck a chord. I didn't really, I think the very first thing I did before I even met him was I bought some environmental stocks. They were all the way back then, they were hot.
Wow.
and of course they were all dogs and, turned into wallpaper. So, like that just really turned me off to fundamental analysis. I figured technical was the better way to go.
And as you sort of, so it's fascinating. You're getting involved in the market sort of in the 70s, and as you continued on, did you have any early mentors or a mentor that helped guide you along this path that you've been on since then?
I mean, no, not really. When I got the job at Thompson McKinnon, then there were some guys who'd been around the market for a long time that helped me out. But really, the option strategy, the listed option market was so new that there weren't any mentors. There were some guys from the old over-the-counter market that I worked for at Thompson or what have you, but they did a lot of things seat of the pants. They weren't really computer analysis, Black-Scholes kind of people. So, so I don't really, as far as learning my way around the block in terms of working for a brokerage firm, the guy like Howard Whitman was the guy who hired me, but I don't necessarily have any, mentors of people's whose names you would know in terms of option analysis. I sort of just figured it out.
You've charted your own course, pun intended, right?
Right.
So
right.
take us on that path after Thompson McKinnon. Where did you go next? How did you get to this point?
Well, so at Thompson McKinnon, after about 4 years or 3 years of doing the retail, um, they traded their own money. So I guess I said I'd like to try to trade some of your money, and they said sure. So we started a small equity arbitrage department, and we were doing that arbitrage I was talking about before, and doing that sort of thing. Then we did a number of just theoretical option trading spreads and that kind of stuff. And then we got a little bit into risk arb. So that I did that for about 8 years, and then the firm went out of business because of the crash of '87, and they'd gotten cut. it was early on, but CDOs was the demise of the firm before it really was the demise of a lot of other
Wow.
firms in the early 80s. So then I went to Prudential for a couple of years. That just didn't work out, and so I started this company in 1990 that I'm still running now. We started out as data research, that kind of thing, but then moved into money management really more in the last 10, 12 years or so.
Yeah. And that's McMillan Analysis Corporation that you started
Right.
in 90, right? Yeah, that's
Right.
great. So you've had it. I mean, congrats on an incredible run with that. I mean, you've obviously found great success for very good reason. Can you talk about, so you've now, as you talk about your experience going through essentially the 74 low, the 84 crash, I mean, 1990s, 94 low, going through that. I mean, can you talk about some of those pullback periods, some of those corrective periods, and what you learned about the markets during those periods?
Yeah, well, I think the one thing I really learned was that it's a lot easier to spot a bottom than a top because the market gets so crazy, oversold at the bottom. And, I mean, I have a lot of indicators that I trust. I'm going to say like 10, not, I guess that's not a lot, but they're typically, at the real bottoms will all be flashing buy signals, and that's pretty easy. But like right now, the market is extremely overbought. I don't really have any sell signals. Yeah.
Right.
But in even last year before the COVID crash, which sort of came out of nowhere, really. I mean, the market was going up, and then 3 days later, it was in total free fall.
Yeah.
We had a few sell signals kind of laying around. Right now, I'm just not seeing any, which makes me sort of nervous because the market's roaring away. But no, but these other markets like 74, 74, I didn't spot that bottom that well. It wasn't that well versed in the indicators I'm using now. But 2008, we handled that really well. That's why we moved into market money management, because the clients that had been reading our research said, I'd like to put some money with you because you were pretty much right on all this stuff. So
Yeah.
that's how we really got the money management thing going.
Now, for you, I mean, we interviewed David Lundgren not too long ago. He was at Wellington Partners in Boston for a while, and we talked a little bit about the difference between analyzing the markets and talking about the markets as a sell side analyst versus managing money and actually putting money at risk using that. Was that a difficult transition for you? Well, even though I know you traded on your own, perhaps less as much, but was that a challenge to go more into money management, or not as bad for you?
Just from the procedural stuff, disclosure documents, RAA, CTA, all that stuff. But as far as the trading, no, because the things that we were using had been back tested, and we've pretty much, I think, been at the forefront of the VIX derivatives all along. Yeah. And so that was a big part of the money that we made in 2008, and then last March we had a very big month that month because of the VIX derivatives, and we have certain quasi arbitrage strategies we use there, So, but that, I mean, the trading, I had, as you said, I had been doing, and then I had done it for Thompson McKinnon too. So that was not a real problem. It was more the regulatory stuff.
Always a challenge. You had mentioned how well you navigated sort of that 2008, 2009 period, which was certainly, I mean, it was a challenging period. Can you take us maybe to a different time where you had less of a good sense of the market? Could talk us through an example of where a mistake in your career, and what was that like? What did you learn from it?
Well, so 2018 had two big drops in there. The first was in January, February, well, mostly February, and that one we didn't really catch it on the signals, but we kind of lucked out. If you recall, the VIX futures had that one day where they like doubled in price. Probably was some manipulation, but not by me. So that kind of saved our bank in there. But then later that year, from October through December, was an extremely bad market, especially in December, leading right into Christmas. And that one we pretty much got creamed on. So we lost some money under management and that sort of thing there.
Yeah.
We have altered our approach to the volatility. We were using the volatility derivatives as a hedge, and they actually didn't perform all that well then, but we've fine-tuned our thinking on that matter. So I don't think that would happen again, but the market will always find a way to try to mess with your mind.
Well, after things like that, one of my former bosses at Fidelity would say, "What did what happened? What did you learn? What are you going to do differently?" And it sounds like you went through that process on your own, tried to adapt. So when I think of you, Larry, you really have been involved in options from the very beginning. But now you're seeing, as you probably know, a huge influx of new participants, right? Learning about options and trying to trade them for the first time. When I'm looking at your website, optionsstrategist.com, you have a lot of great educational content on there. What advice or what suggestions do you give to people just getting started trading options? What should they have in mind as they try to get started?
Yeah, well, a couple of things. I mean, one is there's no harm in owning the stock if the options are too expensive. Although these days, I mean, it does seem to me that the computer guys or whatever are keeping volatility traders are keeping volatility much more in line, with where it should be. That still doesn't mean that you can still lose a lot of money to time value if you're buying a call and nothing happens, of course. So many of these guys, though, the newer traders, I think, are trying to buy a lottery ticket, buy an out of the money call, hope to hit it. Whereas, if you just do a little work, you probably can predict the underlying stock, and then you can buy it, so let's say an in the money call that's going to perform like the underlying stock, and that's what they should really be doing. But we see this difference, and there's two like put call ratios. One is the standard, which is just how many options trade, and the other is the weighted, which is how many dollars of puts and calls are trading. And you see how the out of the money calls have dominated. So that's small traders, and hopefully they would learn from that. And I guess my other big bugaboo these days is spreads, vertical spreads. I mean, every guy on TV seems to be recommending those. They're not the pros, but I mean, the unregistered guys.
Right.
And that's really not a very good strategy unless options are expensive, because whether you buy the call or buy the bull spread, you're risking 100% in either case. And they don't seem to mention that. They just mention you're risking less dollars, but it's still 100%. And with the spread, you cut off your profit potential. So my trading history is full of a bunch of small losses and some very large gains. So that if you're cutting off the gain, that really hurts.
Not a good way to do it.
Right.
Now we're recording this, Larry, sort of late April of 2021. As you alluded to earlier, the markets certainly have been resilient, pushing higher and higher. If you had one chart to kind of help you make sense of things, help you navigate things in the coming weeks, coming months, what would it be right now and why?
Well, I think the most important chart is always the chart of the S&P 500, because I mean, no matter what your indicators are saying, if they're all in sell signals, but the market is still going up, then the market's right and you're wrong. So the number one thing is to watch it for support levels, and if they start to break, then you need to change your strategy to bearish, from bullish to bearish.
Yeah.
So I'm beyond that. I mean, VIX is another pretty good chart to watch, but there you're looking for it to. If VIX starts to go into an uptrend, then that's trouble also.
Yeah. I love that answer. Ralph Acampora, who was one of my mentors as I got started, always told me, it's like, before you look at anything else, just look at a chart of the S&P. If it's going up, you've got to be bullish. And
right.
There's a lot of wisdom in that very simple but very true statement that he said. Yeah. As we wrap up here, Larry, do you have any like a quote or a favorite saying about trading, about investing, that people should keep in mind as they go through their own process?
Actually, this is actually a quote by Fisher Black, Black-Scholes model. So sure. Fisher Black was at MIT when they invented the model. Then he went to work for Goldman Sachs. And so he said, his quote was, "The market is a lot more rational from the banks of the Charles than it is from the banks of the Hudson." Meaning In theory, this should all work out perfectly, but in reality, there's a lot of scary stuff going on. So that's my favorite quote.
As a former resident of both New York and Boston, that hits home very much, Larry. I love that quote. This has been fantastic. Listen, congratulations, Larry, on all your success. And I first met you. I'm sure you don't remember, but I remember vividly meeting you at an MTA conference years ago. And people should know you were incredibly warm and generous and thoughtful then, and continue to be today. So, thanks so much for giving us some time. Congrats on your success. Wish you the best, and we'll keep in touch. All right.
All right. Thank you.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.